Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Oliver Brown of RC Brown, one of the UK's finest investors. So welcome, Oliver.
Hi, Paul. Nice to speak to you.
Yeah, well, like the markets, you seem to have been in the wars there. We've had a very sort of challenging past 6 months, and I think you've been boxing there. So hopefully you're all right. But the markets have been obviously been pummeled on the back of sort of like a cost of living crisis. We've had rising inflation, higher interest rate expectations, the Ukraine-Russia war. And now this last 6 days, we've had quite a lot of distressed selling and dislocations on the market, but equally valuations have really come down and reset. In fact, almost at silly levels in many areas. So I've got an easy question for you here. It's sort of like putting all that together. What's your sort of outlook as an investor for equities going forward?
Yeah, no, absolutely. You're right. I have been in the wars a little bit. It was just a minor operation on my shoulder, so I'm fit and well otherwise. But
you shouldn't say that. You should have you did 10 rounds with Mike Tyson. You should have seen him as well.
Absolutely. That's why I look as I do. But we're fighting fit, and clearly the markets have had, as you say, a very, very difficult week. In fact, have had a difficult year, as you say. The derating of growth companies, the Russian invasion of the Ukraine has added inflation, a lot of inflation to the environment, and it has exacerbated supply chains as well. I think what the market needs to see is some clarity on inflation, frankly, and to see that is coming under control. Obviously, we're seeing interest rate rises as well, particularly in the US, but we'll see some further rate rises in the UK. And one thing that we all know is markets don't like uncertainty, and that's why we're seeing the volatility we are at the moment. And as you say, it does throw up opportunities for the brave and for those investors who've got long-term aspirations. The UK, in our view, is cheap on an absolute term. It's cheap on a relative term. So look, you've got to be brave at the moment. But I think those who are brave and do have capital to put to work, will come out looking pretty good. And one thing that the UK does, it does have dividend stocks as well. And I think in an environment where interest rates are higher and more of your total return is going to come from dividends, then I do think it's definitely an area that's worth looking at. And there are companies that I would regard as growth companies that are now trading on more value type companies, which I don't think will occur for forever and a day.
Yeah, well, you are looking at the way you do. You definitely look a brave man, that's for sure. So, in terms of those dividend stocks, there you've got some quite interesting plays in your portfolio. Large cap, those miners. I see you've actually probably done pretty well out of there. That's sort of like added a bit of ballast, because that's the one sort of like I know it's incredible, but safe haven, even though it's a sort of like a volatile underlying asset, sort of like all things mining and oil and stuff like that. But because of the Ukraine-Russia crisis, obviously it's gone through to the moon. Pricing power has been really good, and these guys have been making tons of sort of cash, etc., and paying out to dividends. Do you want to talk us through those, whether you're sort of like which ones you have, just very top level, and sort of like whether you're going to be trimming at all, because obviously they've ridden the cycle up really well.
Yeah, so we hold BHP Billiton, Rio Tinto, and then a smaller position in Anglo American. As you say, all have done pretty well this year, albeit like most companies in the markets have come back fairly sharply in the last week or so. In our views, it's actually important to own some mining companies, and we prefer the large cap ones because we understand them more. They're more liquid, and they do pay really, really good dividends as well. And they're far less geared than they were in previous economic cycles as well. We think the valuations are pretty moderate. And as you say, throwing off loads and loads of cash. And I think one thing that investors forget, this is part of the market that some investors over the last few years have completely shunned, but on almost environmental grounds. But we need these mining companies, and we need the commodities that they are mining in order to transition to a lower carbon economy as well. And I think that's something that gets rather forgotten, that we do actually need these companies. And
what about the integrated oils? Because I did see you've got obviously your BP and your Shell as well, which got hit originally, so well, when I turned the clock back 2 years ago, crude oil was minus 32 on one Wednesday night, I think it was the 23rd of April, has then now soared to $120 a barrel. But equally, they had to sort of like both BP and Shell had to give up their really quite valuable assets out in Russia.
Yeah, and of course that did impact those companies. But remember, because the oil price now is so high, you know, $110, $115, $120 a barrel, that actually that more than makes up for, you know, say the value of you know, Rusal that BP has had to effectively will give away or write off. You know, these are two, BP and Shell are two quite big holdings in our portfolio as well. And again, a bit like with the miners, is, you know, we don't think the world can do without oil yet, and frankly, going forward, these companies are going to be involved in the transition to renewable energy, and some of the big investors in that space as well. So at the moment, they are generating a lot of cash that they can put towards, you know, their future and what their future may look like. And as an investor, you're being paid for that. You know, these companies are not expensive. The valuations are reasonable, and the dividends are pretty good as well. And even at sort of $60, $70 oil, if the world suddenly got back to something regarding normality, which I don't think it will in the short term, you know, say the Ukraine-Russia war, there was a solution found to that, yes, I would expect oil prices and gas prices to come down a bit, and clearly they may come down a bit anyway, because, you know, the market is starting to price in perhaps some sort of recession as well. So for us, again, these are companies that we think you ought to own. I wouldn't be tearing out to buy BP and Shell right at this moment, because they have had a very good run. But I think on further weakness, I would, if I had no exposure, I would look to buy in.
Well, they also, you know, sort of the last 5 years, their cost discipline has been immense, hasn't it? Because I think was it pushed the clock back to 2016. There was that sort of like competition market share war with Saudi Arabia, and it decided just to pump a shed load more oil on a day, and that brought the oil price down, and forced, before the pandemic, all these big major oils to bring their lifting cost and their production cost. I think it's been, a lot of the time, it's even below $40 a barrel. So when you say $60, they're still making brilliant margins and lots of cash. So so essentially, with the mining and the oil, what you're saying is that they've done really well in your portfolio, but you're going to stick with them because they pay really good dividends, and they're providing an anchor for the rest of the portfolio.
Yeah, absolutely. Until I find something that is more attractive, and at the moment, these are relatively safe havens.
Yeah,
and throwing off dividends of, so in the case of BP and Shell, 4% plus. The miners will actually be more than that, and in this market, that's not to be sniffed at.
Yeah, and then another section on the sort of the big caps, which has been pretty badly hit actually, is the UK banks. And I know I think you own, you own all of them, I think. Is it NatWest, Lloyd? In fact, you think you recently bought NatWest, Lloyd, Barclays, and HSBC. What are your sort of thoughts on that sector? Is the sort of the credit cycle risks that people are fearing in terms of the recession, is that just, it's still way off, they're still really low, or is there a sort of like that's what's really hitting the, you know, the share prices?
Yeah, well, the credit quality clearly is something to look at, and, you know, if we were to have a very severe recession, then I do accept that you perhaps wouldn't want to be in these stocks. You probably wouldn't want to be in, be very few equities you would perhaps want to be in. But I think the important thing with these companies is that they are so well capitalized now. You know, ever since the financial crisis back in sort of 2007, 2008, they've been forced to hold, you know, huge amounts of capital, and actually we believe that they can take, you know, much higher impairments than there are currently. And sure, that there will be more impairments, especially if we move into a more sort of recessionary type environment. But, you know, the thing with these stocks is that they're cheap. You know, they trade below book value. You know, Barclays is the cheapest on 0.6 times book value. I do accept it's been a bit accident prone, which is why it trades on a lower valuation than perhaps NatWest and Lloyds. NatWest and Lloyds will both also be you know, due to increase their dividends. They should be throwing off, you know, loads of cash. And with rising interest rates, this is an environment they've not seen for so long. And, you know, every quarter point interest actually helps that net interest margin, and should provide, you know, greater capital that they can therefore potentially pay out to shareholders. And you then got HSBC, which probably the most expensive of the UK listed banks, but it does at least provide you a bit of a diversification away from the UK. Obviously, with its Asian operations, there's a bit of debate at the moment as to whether they may try and a bit of pressure on them from Ping An to potentially split the business. I'm not sure that's going to happen, but that does indicate that there's potentially some value if you were to split the faster growing Asian operations and this sort of more humdrum UK.
Yeah, I mean, I think there's been a lot of sort of inherent value sort of released. I did see somebody estimating that, I think it was Pinam, so they were talking their own book, but an extra 25 billion, I think it was, if they did it. So it's probably good support, good upside. Now, I know when we last chatted, you were sort of like, you were providing or could provide a window into the IPO secondary funding market, particularly the small cap, because I think sort of RC Brown sees more sort of like new listings and IPOs than just about anybody. It knocks on a lot of doors. It's prepared to sort of get out there and do the rounds. And obviously, I saw some stats which came through for the year to date for April for AIM, and it's down, I think it's 60 or 70% compared to last year, admittedly from a very strong period. What's your sort of view of the overall sort of IPO and secondary funding market? And when do you think it might start to turn and come back?
Yeah, so it is obviously an area that very much interests us because it's our investment process, looking at companies at the stage they're raising money typically. It has been quieter this year, no doubt, and I expected it to be quieter. 2020 and 2021 were very, very busy years. 2020 was very much about companies needing to raise money to protect their balance sheets as a result of the pandemic, and 2021 was more about the reopening and companies are back in growth mode. But it's definitely been quieter than we would have expected. We've obviously seen the growth company valuations contract, and obviously the situation in Ukraine, the war, has clearly put a lot of pressure on stock market. So it has made raising money harder. Having said that, we have still seen activity. It's been more specific in terms of sectors. There have been some property companies that have raised money, LXI REIT, for example, which is a FTSE 250 company, Home REIT as well. And then some more infrastructure companies, clean energy companies, the likes of Gore Street Energy and Bluefield Solar. So there is money being raised, but it is in more modest amounts, significantly more modest amounts than in previous years. And in terms of when that comes back, well, now going to be certainly the IPO market is shut at the moment. There's just too much market volatility. We have though been seeing some sort of having what's called early looks at some companies that would like to float. They may be able to get them away. That these have been small caps. They may look to float in sort of Q4 this year, but that does assume that there is some stability in the market. You don't need a rip-roaring bull market for them because these are actually pretty good companies. But now, unfortunately, it is not the time. A lot of investors are running for the hills or sitting on their hands.
Well, I'm guessing that. So if you've got sort of like not all these dividends coming through from the miners and from the oil companies and from the banks, and you haven't been spending as much on the IPO market, you're now sort of like pretty much with a lot of strategic capital to deploy. And just on that, sort of like moving down to some specifics that I think it was somebody, maybe one of the firms you invested in last year, Big Technologies, which has done remarkably well. It's a sort of like electronic offender criminal sort of like, tagging business that is really, I think it's best in class. It seems to have the best sort of technology and, in terms of their tracking, etc. Do you want to take us through that? Because it really, given it's a technology company and we've had sort of Meta down 50% and Tesla's down 40% and you've got Zoom down 70%. I think this one is still above its IPO price and delivering really, really strong results.
No, absolutely. It is about its IPO price, and it does have some very well regarded and strong management who, so far have delivered on exactly what they said they were going to do. You're right. It is very much about remote sort of tagging systems for criminals, really knowing where they are, and it's used globally by governments. They haven't yet lost a contract. There are potentially some other markets that they can go into. So, think healthcare. Perhaps if you've got an elderly relative and you just want to have knowledge that they are up and about, you know where they are, then it could be used in that as well. It is a genuine growth company, growing in excess of 20%, got good margins as well. EBITDA margins would be sort of 25% plus. Got net cash on the balance sheet. So the one thing that you just have to be aware of in this market is, it's still on a price earnings of around about 30 times, which is high in this sort of market. But it has so far delivered, and we've continued to hold the company. But we'll probably come on to some other names that have been rather more materially derated as well.
Yeah, well, I did see actually they're broken. I can't remember who it is, but it could be Liberum or somebody like that. I'm not sure who it was, but they're
broken.
Zeus is it? Okay. Well, I saw the numbers out for this year are 46, and then they a sort of 46 million turnover, and they announced that their last run rate IRR was about 4 million a month. So if you just go 12 times 4, you get 48. So it looks pretty, in a recurring revenue stream, it looks pretty underpinned. And I do understand, actually, I did read somewhere, I think it was an RNS or something, not only on the tagging, what they're adding a bit of technology to be able to to be able to see, because obviously tagging tells you whether an offender who's supposed to be at home has breached his, sort of like where times, etc. But equally, if they're sort of like, if you want to sort of monitor whether they're abusing drugs or any other illicit sort of like, narcotics or even alcohol or whatever, I think they're looking to expand the technology footprint to be able to try and monitor for offenders to see whether they're also, sort of like meeting those requirements, which again could be a huge market and unique for the technology, I guess.
Yeah, no, absolutely. And these governments with these contracts with governments, are long-term ones, and are not cyclical. So they should continue to be able to win further contracts, and, as you say, expand their presence in what they do.
Yeah, and then moving on to sort of like another area, which is basically badly hit, but it's all things sort of like, housing, repairs and maintenance. You got sort of like, you did the IPO with Lords Group Trading, I think it was last year, and then obviously Brickability, which is probably last year as well. And both of them have been hit, but they seem to have, equally delivered on their numbers. I think Lords is it's a UK sort of like distributor of heating and plumbing products and sort of like, building merchants and going about 20% per annum. Brickability is a sort of like a building sort of materials distributor as well, sort of on a buy and build strategy. But both of them have knocked the ball out of the park, but badly hit. What's your sort of views on that sector and also those particular stocks?
Yeah, so they have, as you say, both been, they're now both, in Lords' case, they're now trading below their IPO price. On obviously the macro concerns out there, our view is still that people are going to want to make improvements to their homes. That's one thing that COVID taught us, was that actually we want, most people now want a more flexible working environment, and that does mean that people will adapt their homes accordingly. Albeit, I suppose you have to bear in mind that now, if the consumer's coming in under pressure, maybe some of those plans might be put off. But I would say that has been very much factored into these share prices, and certainly the companies have not seen any sign of that as yet. And these things are growth companies, not out and out growth companies, maybe that like big technologies is, but they are growing at a decent lick. In Lords' case, it's certainly growing considerably faster than the market. It's a consolidation.
Double, I think, isn't it? Double, faster, twice as fast as Travis Perkins.
Exactly, and it's a well-run business, and it should be able to buy some other complementary businesses, and improve their performance, which obviously should add to the rating as well. Brickability, there's still a need for new homes to be built in this country. That's patently obvious. And as you say, both so far, their track records, on the market has been good. They're on price earnings ratios of 10, 11 times. They're paying you 1.5%. I think there's certainly far worse places to be than these two.
And I certainly, I'm not that familiar with Brickability, but I certainly know that Lords has got a sort of like a really entrepreneurial management team and a track record over decades. So it's been in the business and it knows how to, it's been through anything. If we do get a severe sort of great financial crisis, these guys have been through it. They know what levers to pull, so they'll be fine on the other side. Now, another area that again has got entrepreneurial management, in fact, exceptional, is Supreme with I think Sandy Chadal or Chahal, and I mean they do sort of like vaping products, and I think they just bought a sort of like a quite big or reasonable complementary vaping business just recently for about £12 million. Do you want to take us through this one? Because again, it trades on sort of less than 10 times earnings. It seems for a branded business, for, you know, on vaping, obviously it's got batteries and other sports, but for branded business, it seems, I don't think I've ever seen a sort of like that cheap.
Yeah, so we bought this at IPO in early 2021. The shares did very well to start with, but have actually now fallen back marginally below their IPO level. There's been a bit of concern over the sports nutrition business and the rising costs in that. But you mentioned the batteries and the lighting, which are sort of the steady eddy parts of the business, and the vaping bit is growing very fast. And vaping is to produce is very cheap, and the margins on it are very good, and they supply to a number of retailers. So it's on a P, as you say, sub 10 times. It's got a dividend yield of 4%. On entrepreneurial management, have been doing this a long time. We think the shares are too cheap in simple terms.
Yeah, I think there's quite a lot of them, sort of like in that ballpark. Now, another one you own, which is Anexo, which is a sort of like a vehicle credit hire business, legal sort of services, but it also has been helping people sort of like make claims against the likes of VW for the Dieselgate, and they've got a big sort of like payout potentially coming up in that. So, do you want to take us through this one? Because again, I mean, I was just running the numbers. It trades on 7 times PER, price earnings ratio.
Yeah, very very much an unloved stock. I've never quite understood the valuation of this company. It does look too low, and it's been low for quite some time. As you say, it's a credit hire, a legal services company, what you call no-fault motorists. So perhaps if you're a delivery driver or a courier and you've been knocked off your moped and it's not your fault, then the likes of Anexo will represent you on a sort of no-win, no-fee basis. They have got other areas that they're moving into, sort of housing disrepair division as well, which goes after landlords that are not keeping their properties up to sort of legal standards. And as you say, the real catalyst, I think, right here and right now is the vehicle emissions scandal. They are representing a number of thousand VW drivers who bought cars that actually are now not worth as much as they should be because VW had been manipulating the emissions data. The company actually did receive a bid from private equity last year as well that was we thought was derisory, and management certainly thought that as well. So the bid was withdrawn. So that also could come back into play if these shares remain where they are at the moment.
Another, well, actually, yeah, I was just thinking. Actually, I suppose if once they've complete the one with VW, they'll move on to people like Mercedes, won't they? So
VW could be the start. Yeah,
it isn't just a one shot. There's a few people who unfortunately fell into the Dieselgate scandal, or may have done anyway.
And we'd expect to see. They're hoping to hear from get a result on the VW case in Q3. So quite.
Yeah, no, I mean, I've heard the number could be well over 20 mil for their portion of it. So, which is material, given I think there's it's 120 million share counts. So that's at least 20p per share, isn't it? So that's added on. Now another legal services, which seems to be the valuation has just been hit again, sentiment, and I can't see why. Is K3 Capital, which does sort of M&A advisory, corporate recovery, forensics, and I'm not sure it does insolvency, but it basically does restructuring and turnaround and stuff, which is as we know could be flying off the shelves, that service so it's well sort of balanced, etc. And it's trading on again about 11 times PE, and I think it's run by the CEO John Rigby.
Yeah, that's right. So we bought into this company when it raised some money last year in order to add some complementary businesses and teams. And I would expect them to continue to do that and become a more broadly diversify as a professional advisor to small and mid-sized companies, it should prove, relatively resilient in an economic downturn as well, because small companies still need advice, throughout the economic cycle. So that doesn't really worry us. And of course, the valuation is very compelling. We have this stock in our AIM-IHT portfolios, and it's kicking out a yield of 4.5%. Again, where else can you find that? Well, not that many other places in sort of small cap land.
And it seems to have plenty of cash on the balance sheet as well, actually. It's, it seems got sort of 4 million of cash, which is, again, about almost 10% of its market cap. So it's
trades at a discount to other professional service companies as well.
Yeah. Now, moving on to some more sort of fallen angels, consumer brands that are going unbelievably cheap. Hotel Chocolat. Now, I actually watched a documentary on this company. I think it was Channel 4 or Channel 5 with Angus Thirlwell, and it was brilliant because what sort of like came out was the passion and the love of their employees about the actual product. Do you want to take us through this one? Because it's sort of like a really high kudos, level of chocolate brand, etc. That is sort of branching out into other products and geographically.
Yeah. So, have you tried their products? Are you a fan?
Well, it's very nice. I can't eat chocolate because it doesn't agree with me, but my wife loves it.
Okay. So yeah, this was a bit of a stock market darling, this company, when it floated back in 2016, I believe. And I say many people will be familiar with the brand and the shops and the online retail business. And like many consumer-facing stocks, it's derated very materially. It's still trading well. It's been expanding internationally. It did raise some money not so long ago to expand, help its expansion into Japan, that is going so well so far. And whilst we do acknowledge that the consumer is under pressure, whilst these might be expensive chocolates, these are relatively small items, for people's birthdays or for anniversaries, or just as a treat, 5, 10, 15 pounds. So we do acknowledge this could get worse in terms of the share price before it gets better, because this is not a cheap stock. It's PE's around 20 times, sort of sub 20 times now. But for the quality of the management and the quality of the brand and the fact that it is now it's an international business, we think it's too cheap at these levels.
Yeah, I mean, 8 times EBITDA looks definitely good value for this. And apparently, it sort of launched doesn't obviously just do the lovely chocolates. It just launched, is it Velvetizer? It's sort of like hot chocolate machine.
I have one of those myself, yes. And
what now, what's it like?
Yeah, it's very good. It's very good. Yes, it makes very high quality chocolate, hot chocolate.
Brilliant. Well, I mean, that's another sort of big growth area, growth engine for it. And I think there's lots of others. I mean, who knows what would happen, but I mean, it wouldn't be surprising if one of the big major sort of like, international luxury chocolate guys come knocking on the door, because Mondelez bought Green and Blacks, didn't it, years ago? And, these take ages to build up. And the inherent sort of like, brand value is never reflected into the shares unless you get a sort of like a major sort of like, sort of like transaction event.
Yeah, it's possible. I mean, I think management feel they've got a lot more to do with the business.
Yeah.
For that, so it would have to be a pretty knockout offer, which you say, you never say never. Another
one which is actually knocking the ball out of the park, and it seems to have been really unfairly hit, is Revolution Beauty, which is again is a sort of affordable cosmetics and skincare, hair care sort of products business that is a challenger to sort of the big likes of Revlon and L'Oreal, and expanding really hand over fist in the UK, the US, and overseas. And the shares are sort of like about half the valuation that the brokers got, and the IPO are about 160, and they're about 80p at the moment, which looks just ridiculous for sort of like a high quality brand that is really chiming with consumers as they go back to work and now want to go out to party, and they're looking for sort of like good sort of reasonably affordable high quality cosmetics.
Yeah, this is a genuine growth stock that is actually their performance since IPO has been pretty good. It's been pretty resilient in, obviously a difficult market. And actually, it should be an element of consumers looking to move to slightly sort of cheaper brands, and this is what theirs are, but their margins are still very, very strong. We do see this as a disruptor in the industry, up against the established players such as L'Oreal and Estee Lauder. They've got huge ambitions for the business. The US is now the biggest part of their market as well, and if they can get to their sort of £1 billion sales, which is what they hope to in the next 5 years, with the margins that we're talking about, again, so 30% plus EBITDA margins, then these shares are simply the wrong price. But they are very unloved at the moment, and are being caught by the sort of the mass sell-off in sort of small caps and consumer-facing companies.
Yeah, and I think if people want to sort of like take some public information and have a look at it, then you've got the likes of War Paint Cosmetics knocking the ball out of the park, which is another challenger brand. You've got Elf Cosmetics out in the States saying that they're growing hand over fist, which is to say the biggest market. And I think you've also got, even though Target and Ultra Beauty as stores and distributors are suffering, their cosmetics lines, well, I think Revolution Beauty plays, are absolutely just go roaring. So it just seems, yeah, you're right. It's baby in the bathwater stuff, isn't it? It seems to be anyway.
Yeah, we'll certainly look forward to the next update from them, because there's a profit warning coming, or the shares are the wrong price. So.
Yeah, well, even if there's a profit warning, it still doesn't mean they'll still be at the wrong price. So anyway, we'll wait and see. Now, sort of like long-term secular growers you've got is one buy and build is Marlowe. Do you want to take us through this one, which seems to be sort of like really sort of becoming a dominant world-class leader in supplying services for sort of regulation, health and safety for corporates, all in the UK and abroad, I guess, and getting huge economies of scale?
Yes. So Marlowe historically is a fire and safety and water testing business, but what we've actually seen it do is move into a sort of a broader range of services. So the risk and compliance is now the largest part of its business. It's also now moving into software as well, again, sort of compliance software, which is on longer term contracts and higher margins. So that's what's helped the rating of this business, is the fact that it's moving into sort of higher margin, longer term contracts. And these are services that companies need year in, year out. So again, they should be pretty sticky as well. It is a buy and build. It is one of the most acquisitive companies I've ever seen, but they do tend to be sort of quite modest bolt-on acquisitions, and so far their record has been very, very good. They trade on sort of their PE at around 18 times. They're at the lower end of the multiples that it has historically traded on, and we think that the shares are at these levels represent decent value. I would argue that there are perhaps cheaper things in the market, given in recent weeks, but this is one of our larger holdings in the fund.
Well, it's high recurring revenue streams, isn't it? So it is a bit of a sort of healthy, it's sort of a safe haven, I guess. And the bigger it gets, the more barriers to entry and networking effects it generates, because it means that new entrants are competing against somebody who's got that sort of milk round sort of effect, whereby it's visiting and it's seeing and it's servicing so many clients in the nearby. It's almost impossible to break into that, sort of generate that level of gross margin and operating leverage.
Yeah, and their target is £100 million of EBITDA in the next 3 years, which they're well on course to hit.
Yeah, and just for investors, their market cap is it's like they've got 30 million of cash on the balance sheet, or roughly around about that, and their market cap's only 770. So it's sort of like 7.5 times EBITDA. That would be pretty cheap for a really high quality recurring revenue business. Now, the another one, which is sort of like IPO'd last year, is Saietta, which is a leading axial flux electric motor business that came out with a good operational update this week in terms of now being able to offer systems. But as the world now tries to sort of decarbonize and goes through into all things electric, particularly in transport, and given its patented portfolio, it seems in the able position to be able to really sort of scale up over the next few years and drive significant growth. What's your sort of view on this one?
Yes, so these shares again, they got off to an incredible start, after IPO, and doubled, and have come back very significantly. They're still trading above their IPO price. The market opportunity is enormous. Electric motors for electric vehicles. Now think mopeds rather than Teslas. So it's more of an emerging market, perhaps, play. And as you say, the update the other day was very promising. We're seeing contracts come through for their sort of e-drive systems. And the forecast growth that's out there is really, frankly, explosive. This company, and so far it hasn't put a foot wrong since it's been a listed company. 20 million pounds in 2023 revenue. About 60 million in 2024. If this hits anything like that, at £1.50, these shares are, again, the wrong price.
Yeah, and with leading technology, and they've just got to get onto some platforms, haven't you? If you get onto some sort of OEM platforms, whether that be for 2 or 3 wheelers, whether it be for sort of like, the motorboats, or whether it's also, the delivery vehicles, or even high performance cars or trucks or anything like that, then these things tend to have lifespans of 10, 20 years. And on that basis, you've got assured revenues for decades, which is in a growing market. So
yeah, I mean, an impressive CEO as well. And if they hit their targets, then someone ultimately will come and buy that company, I would think.
Yeah. Now, in terms of the final one, sort of Strix, which is a sort of like a dominant sort of, I think it's a heating control company for kettles and this sort of stuff. Can you take us through this one? Because again, it's sort of like it's trading on about 11 times PE for sort of like a patented designer of these specialist controls with really good pricing power.
Yes, so this has got a 50% global market share, which I can't think of many companies that have that level of market share, especially with the market cap, the size of this, small cap. They also have made a recent acquisition, which is bedding in well, called Largecap, which is an Italian water filtration business, which does add some diversity and breadth to the business. The shares, like a lot we've been talking about, have come back, quite materially on cost input pressures and concerns over supply chain. They've got a lot of manufacturing out in China. But this is a global leader in what it does in kettle safety controls. And these are now come back to a PE of 11 times, dividend yield of 4.5%, growing at 10% a year or so. Again, these just look too cheap.
Yeah, they just look at silly valuations. So sort of coming at sort of like full circle then, back to my original questions, outlook for sort of equities and particularly the small caps. I mean, it sounds as though you're pretty positive because, yes, the macro uncertainty is higher, but if you've got less competing money coming into the markets for IPOs and for secondaries, and, the share prices have come down, plus you've got distressed selling, it sounds as though actually your longer term view, as long as you're prepared to take to some volatility, I don't want to put words in your mouth, it sounds pretty positive.
Yes, if you believe in the quality of the businesses that you've got, then you have to stick with them, because what we've seen is we've seen sort of money coming out of the market, and the things that are easiest to sell, the FTSE 100 and FTSE 250, but there's no buyers in the small caps. All you get is sort of retail sellers, drip, 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 drip. I'm not aware of much in the way of institutional selling. So we just think that when it turns, and I don't know when it's going to turn, when money starts coming back into the small cap area, because these have been sold off so sharply, growth companies that are now looking like value companies, but when it turns, it'll go the other way and pretty quickly. But when that's going to be, I don't know. But in the meantime, if you're talking about the likes of Strix and Supreme, that are decent businesses that are paying you a decent dividend, and yeah, we are. It's difficult to be positive right now, but you have to look at the valuations of these companies, and what the market needs to see is some clarity. No matter how bad it is, it needs to see some clarity. If it sees clarity that inflation is starting to be tamed, and that we're not going to say have a serious recession, then the market should re-rate, especially amongst the small and mid caps, which have been hit very badly.
Yeah, I think if we give it 12 months, you'll see inflation definitely have peaked, and things will starting to roll off. There's green shoots already in certain things like people, companies are just selling off surplus stock in, say, retail. You've even got Amazon, which has now created surplus warehousing space, and that pricing of logistics will be coming back and making it more available. You've got these type of and obviously you've got the tech guys who are starting to have hiring freezes and also layoffs. So there's certain pockets where you can see that actually you're starting to get more supply coming on, and deflationary forces. So in a year's time, if you're prepared to wait, I would hope that the market would have had a bit more clarity, will be a bit less skittish, to say the least.
Yeah, no, I'd absolutely concur and agree with that.
All right then. Well, thanks very much, Oliver, and I hope you don't have any more boxing matches over the weekend, or if we do, then I don't want to be the guy who's fighting you. That's for sure.
Well, thanks for having me. Now I've definitely retired from boxing.
Yeah. Okay. Well, take care, and speak to you again in about sort of 6 months' time.
Okay. Thank you.